we speak to is looking at property investing the wrong way around.
How is the Melbourne situation or the Victorian state budget looking relative to Sydney, relative to Queensland?
The RBA's rate cutting cycle has begun.
Are jobs being created?
Yes.
What types of jobs are they?
Melbourne's population continuing to evolve over the next few years, getting lots and lots of people dominating the space there. Everyone we speak to is looking at property investing the wrong way around. They're starting by looking at data metrics to work out where demand is and where people are buying. But what is driving the change in the first place? What is the economic change and the behavior changes that is leading to property investors and home buyers increasing their activity in a certain location? That is exactly the framework that we take when we look at property investing. In this episode, I have economics whiz with me, Curtis, and we're going to run through 5 metrics that help you work out where to buy before everyone and before the data starts looking good. The age of data-driven property investing, that is now behind us. In front of us is working out exactly how to work out where the data-driven investors will go and where the data will change before it does. This is about being ahead of the curve, being 6 months ahead of where everyone else is, positions you perfectly. By the end of this podcast, you're going to have a much, much, much clearer idea of how to do it. So you're one step ahead of pretty much everyone else. Curtis, what do you think?
The data-driven buyers agents and the data-driven, phenomenon actually helps with this because it means when the data does change, you have the support of a wave of investors coming in to ensure that your punt is successful. Whereas, 20 years ago, much harder because you didn't have that kind of support or the big charge of people coming over the hill that you could predict.
Yeah, for sure. This is really, really funny, Kurt. I was doing some market research for Alaya. So I've taken on the role as kind of chief investment officer there, where I play a role in working out where we should be looking and why with Adi. As part of that, when I did this, was understanding the industry a little bit better and understanding what people are doing. So I went to an event, a property event. I met so many buyers agents at this event. I was just shaking hands, saying hello, meeting people, having conversations, doing what I do. Love talking property with anyone and everyone. Every single one of them, they're just I asked them, being like, hey, so what makes you a bit different? Some of them said some cool things like, hey, I'm cool, or I've bought properties, or, they had their own individual stories. But then I'm like, how do you buy? And every single one of them said exactly the same thing. All of them. They said that I use data metrics, I use H-tag, or I use DSR, and then I pick these suburbs, and then we go and buy. And I'm like, oh, do you mind sharing? Where have you bought? Just the same areas that we've touched on all the time. It's just investor after investor going there. The problem with this approach is once the data has looked good, it will stay looking good for a period of time because there's a momentum flow of all these other people starting to do it. The followers, just like in every market. There's one leader.
People come charging in over the hill.
Yeah, and there's 100 people that just follow them, right? So the industry is dominated by followers, and investors who track the industry or hear the content that they consume from it is also tracking and following the same approach. This is a different framework to look at it. The framework that we use for our investing, I've said planning a lot in previous podcasts, but that's a different framework as well. The framework that we use it starts with a form of economic improvement and change here, and we're going to go through the 5 metrics that we use in this podcast. That then flows through to the data. The economics is a study of people's behavior and a study of a city and locations frameworks and behavior as well as to what's changing there. That then flows into the data about 12 months later, 6 to 12 months later. And then there's huge price change because that data metric is where demand outstrips supply, and that's where the price growth happens. So that's where everyone is looking, where the price growth is starting and where it looks. And they're using it scientifically, being like, hey, yeah, this is where prices do rise. And then there's the property-specific deal making. You got to make sure you don't overpay for things. You got to buy the right type of property. You got to execute a good deal. You got to find yourself a deal. The hungry bit in finding a deal. Love that bit too. Love deal making. That's the really, really fun part of property investing too. But this podcast is about the first bit, and I want to get your thoughts on it. So let's go through framework Number 1, housing finance data. This tells you who is buying where. Curtis, what do you think of this?
Yeah, this one is super useful because it gives you a live breakdown of where the demand is coming from. Because we got a breakdown in the data. Is it owner-occupiers? Is it investors? You've got a history as well. How many how many loans are being approved? How many finance applications are going in a particular area? You can track the change in volume and the split between owner-occupier and investors. So like you say, it tells you, it's a good way to get an insight on who is buying. So as much as it is about the numbers, it also tells you who are the buyers in these markets.
Yep.
Is there a change? Are there a flood of investors coming in? Are there all of a sudden a bunch of owner-occupiers that are upgrading? It gives you a bit of those insights that just the straight up maybe data metrics of days on market, it doesn't disaggregate down into who is the buyer.
Yes, exactly. So housing finance data definitely gives you that. Comes from the ABS, comes out every quarter now. I am pretty sure of that. It used to come out monthly, but now they've just made a recent change and it comes out quarterly. Now it's much harder to read. You literally go, I spent time on Excel, running Excel calcs. ChatGPT can probably do this for you. So, but Excel is how it comes out now when you want to bury into the richness and get the data analytics in there. And you can find out details there. There's a few charts that are listed as well, and you could start seeing the trend. Things that I pick up from housing finance data is confirmation of inflection points. So housing finance data could look a little bit like this. Most of the time, it's always on an upward trend because values go up and the number of people seeking a loan goes up. So the total housing finance increases. And in Australia, you need credit growth around 5, 6, 7%. That's just every year we need that.
That's the baseline.
Yeah. Anything below that, it's just we might be hitting recession because what's going on. The number of credit is coming down, so the value of things going down. So that trend, you can see inflection points. So you can see cycles. You can see early points in cycles wherever you start seeing something go down and then go back up. That's one lesson I can take. The macro inflection point and cycles. The reason why I say that is we are at a macro inflection point, not quite in the data just yet, but we will be at an inflection point in certain states. So I expect to see Victoria go from this, that inflection point, very, very soon. We saw it in Darwin a little while ago where it went like this. So it gives you the aggregate story of what's going on. Then there's a second bit to this story about who is buying.
Yeah.
And this is in the Excel tables, but you can also get, if you don't really want to get too detailed into it, you can also just look at charts and you can start seeing the value of investor loans or the total investor loan amount. Typically that goes down. This sounds a bit weird. The typical loan value, disaggregated, is just more and more investors will drag the total value of a home purchase down. That makes sense. If you have a market that's 50-50, owner-occupiers, investors are probably buying at 750 and owner-occupiers probably buying at 1.5. The market then goes to 60-40 and the investors are paying 10% more and they're buying at 820, right? But the owner-occupiers are still paying 1.5. You're going to start seeing that the total value of loans is coming down because it's more dominated by the
lower end of the market, the investor end of the market. Yeah.
Exactly, right? So Darwin, for example, where we can track this investor data, where it's rocketed up recently, in the last quarter, there's been a 50-60% increase in the number of investors there in the single quarter, gone from 260, 270 to 420 in a single quarter period. I didn't even do the math there. Just huge, massive increase, number of investors there. You can see there's been an increase in owner-occupier total value, of an individual loan, up 8% in one quarter. That probably tells you something. How much has house prices risen in Darwin? I don't think it's going to be that far from that. I know I've said something crazy. You looked at me being well, this guy's bonkers. He's saying that Darwin house prices are going to rise more than 25% while everyone's saying 1%. One early metric for that is in the finance data being people are seeking loans that are 8% larger than the previous quarter, being
why? Yeah. What are they buying? Yeah.
That's huge. That's owner-occupiers doing that. That's the people on the ground. Meanwhile, the investors, the total aggregate one, has come down a little bit. Again, it tells you that it's investors driving that market. So there's richness in this data that tells you who's buying and why they're buying, and it tells you inflection points too. So I love this data set.
And the house price data lags this, I think is probably the key point to make, is that this is a good leading indicator.
Yes.
Because obviously if the house price data's already moved, then it's a bit of a moot point. Yep. So we're looking for things here that move before the house price data does.
Exactly. House price data comes out 3 to 6 months later, even on hedonic indexes. I love CoreLogic, and they're the best at this, but on the ground, the movement happens before the data. I don't know if that's why that happens specifically, but it's probably because the settled transactions get shown a few months later. But whatever it is, it takes a little bit of time to feed through into the actual price data. So you can tell what's going to happen to the price data. That's when the media and the momentum swarm happen. But before then, 3-6 months before then, you get the housing finance data. It's more live tracking of what's going on. So that's why it's particularly valuable, because it tells you where people are looking, why they're looking. It tells you a full story if you know how to read it. That's why I like that one.
Yeah, I think that's a pretty top leading indicator. Like you say, publicly accessible, a little bit, maybe ChatGPT can do most of it for you, but without ChatGPT, a little bit annoying to unpick. When you get the raw data out of the ABS, it's not that pretty.
Yeah, we'll keep unpacking it for you. Just watch this podcast.
But it is
way more entertaining than looking at Excel charts.
It's a rich data set, though. There is
Yes.
a lot of information there, and you can disaggregate it and break it down into like the different subsets that we've kind of run through.
For sure. What have we got next?
Lending changes is number 2.
Yes. I love this one because lending changes are measurable and predictable.
Yes.
The coalition government has come out and said that they're going to drop the assessment rate. I can tell you that's going to lead to a 10 to 15% increase in the borrowing power. The RBA's rate cutting cycle has begun. Each rate cut adds 2.5% to your borrowing power. Combine them, you can add in a 17% increase to your borrowing power from these. Now use market expectations of interest rate cuts, or use the fixed rate for 2 or 3 years, just as an example of where the interest rate's going to be. You can start adding in what the lending change is. If you know lending calculators, obviously we live and breathe this stuff. We understand this. But you can predict how much more money people are going to have to get a loan in the year ahead or in the 12 months ahead. You don't need to look at it right now. You can look at what it's going to be with a little bit of judgment, a little bit of application to it, a little bit of theorizing, I guess. You can start predicting exactly what it looks like. It is predictable. If you just learn to understand it, it's not that hard to follow trends here. This is particularly valuable because you can start reading the entire Sydney property market, the macro to it, and the Melbourne macro market to it, just from this. This will drive the 2 biggest capitals in Australia.
Yeah, I find this is one of the easiest ones to unpack. Not just from a Sydney and Melbourne perspective, but also from like a Darwin perspective. If you have borrowing powers in Sydney, let's say people can borrow an extra 2, 3, 400,000, something like that. Or in Melbourne, maybe they can borrow an extra 2, 3, 400,000. Then it becomes, what are people going to do with that borrowing power? What are the chances that as a cohort, these people sit on their hands and do nothing and say, hey, I don't want to access debt. I'm scared I'm going to lose my job. The economic conditions, I'm not interested in it. Like in Australia at the moment, I'd say pretty unlikely. Like, what are the chances that they're going to use that borrowing power to like upgrade their owner occupier or, seek more debt in the markets that they're in? Like, pretty good. So that's where, Sydney and Melbourne uplift is good. And then also, if there's a bit of a wealth effect for Sydney and Melbourne property investors and they've got a little bit of a borrowing power boost, like if they are property investors, where are they going to go put their money? Like, they've got the capacity maybe to add a property to their portfolio. And then you're looking, okay, well, if people are following kind of a data-driven metric, then these property investors are going to have additional fuel that they can pour into a market like Darwin or Northern Queensland or wherever you think they're going to go. It's like all these property investors are going to have a little bit of ammunition, and the economic conditions support the idea that they're not going to just sit on it. They're going to use it somewhere.
Yes.
So then the analysis becomes a bit more,
I call this the domino.
Behavioral, but like, where are people going to put it?
Yes. This is called the second wind domino.
Yeah.
And you start experiencing this. So let's unpack that as our family household. Let's just say you bought a house in Sydney 4 or 5 years ago. Sydney's the wrong city to use. Call it Perth. I'm living in Perth. Bought a house for $1 million. It's now worth $2 million. I've paid $500,000 of it off over the last 5 years. Maybe I got 70% loan or 80%
Yep.
loan. I'm now sitting on $1.5 million in equity, and property has made me all of my money. $1.5 million while I am just a normal person working a job, being like, what the hell? Being like, how long will it have taken me to save $1 million? A very, 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 very long time. Maybe my entire life. You now start getting into I like property. Property is pretty cool. What's this property investing gig that people have? Can I do that? That's what happens, right? And you have this across millions of people.
Exactly.
Some of them are going to be there being like, oh, I've got all this equity. I've got a promotion at work. I got some more income, or my partner's gone back to work. Whatever it is, there's an increase in income that happens. And then you start using that domino impact to be like, I want to invest in property. Where does that money go? It typically flows to where you are locally.
Located, exactly.
But now it's becoming a bit more broader than that because there's more suppliers around that are helping there and dominated by content people. A little bit like us. We could reach, 10 people before, but now we reach, 5,000 plus all the time. Like that's information is now shared to everybody across Australia very openly and freely. So that person in Perth, for example, might be listening to this being like, what's this thing about Darwin they said? The world is changing a little bit, and this is the second wind domino impact that you're talking about. Really, really cool point that you've raised there. Not even on our list of things.
I'd kind of classify that as, lending changes. It's more, lending changes mean people have more access to debt.
Yep.
Then pretty simple judgment call. What do you think people are going to use an increased ability to access debt? Like, in a recession, the answer to that might be no. In current conditions, I'd be pretty confident saying the answer to that is yes.
For sure.
And then if you can predict or you've got a good feeling for where they're likely to send that debt, like they're the markets that are going to do best. So you've got owner-occupier upgraders, Sydney, Melbourne, these types of places. But it also puts a bit of fuel in hot investment markets or what will be a hot investment market.
Sure. I think I've called this, let's bulk this into the third point, which is you talking about net wealth impacts of people's net wealth is now translating into different economic improvements in their own individual life, and that's translating into the investing scene and the economy at large as well because of the wealth that they're making that often could create spending in that area. There's that change. That's an economic change when there's wealth happening there that can create second wind effects to their property market because the wealth impact came from property in the first place. So it can create a longer cycle as well when it's done really, really well. There's an additional element to that, so we're going to call this the third point, is the net income impact. So I've done some modeling on what borrowing powers look like year on year, and when you do this, you notice that borrowing powers increase year on year. Person applying for a loan in 1990 was getting 100 grand. Person applying for a loan in the year 2000 was getting 300 grand. In 2010 was getting 600 grand. Now they're getting 1.5 million or 1 million or whatever it is, right? The amount of debt that you get increases because it's based off your net income. Lending policy changes all cycle around. They go up, they go down, they tighten, but governments control it. But the general line is up and it's tied to your net income that you get after tax income. So things that impact your after tax income do drive your total aggregate increase in borrowing powers and marketplaces as well, particularly in Sydney and Melbourne again.
Yeah, and that's a little bit tied to economic performance as well. Like if you zoom out a little bit from someone's individual situation, individual household. So, like we've got strong population growth in Australia. I've got some numbers here. It's like the projections are high, 2% in this year and then 1.5, 1.4, 1.3. So like above 1.5% population growth year on year for the foreseeable future. So
great fundamentals.
Kind of, yeah. And that's where you are getting at least in Australia, a long track record of pretty consistent net income rises over, the decades.
Yes. So I think part of this will feed into the fourth point, the state economic changes that we are talking about. Like, how does a state and an area start improving over time? So population is a big reason for that. Again, something that I look at Melbourne, I'm like, I can see Melbourne's population continuing to evolve over the next few years, getting lots and lots of people dominating the space there, seeing less interstate migration. I don't think people are going to go up from Melbourne to Brisbane anymore because Melbourne house prices are cheaper than Brisbane.
Exactly, yeah.
Why am I going to Brisbane? Yeah, good weather, maybe Bluey World, maybe that. There's a few things going for it, but Melbourne's got a lot going for it too. So, you're going to lose some of that interstate migration. Some of these migrational patterns that people have is associated with housing markets and job creation as well. So as long as Melbourne continues to have employment growth that is particularly strong, it's been very strong and it will continue to be strong. And its population keeps rising, you're going to start seeing migration patterns continue to evolve towards Melbourne. It always gets the most international migrants. It'll continue to get that, but now it's going to lose its interstate people going away. More and more people are going to come to Melbourne. Sydneysiders are going to go to Melbourne and be like, it's cheap here. Like I have that conversation a lot with people. So there's that economic change there. That means more housing demand. And then there's state budgets looking at it. What does it look like? How does the expenditure look? What does the change look like? What are their growth forecasts? Where is the money going? What specific locations are they doing it in? Where is the investment going? So state budgets give you a richness of information, and you can get into centered locations as well, which can then really help you point out where the data will change as well. Investors will start following the data trends. Once that money goes in, people start getting jobs, more owner-occupier demand goes in there, days on market goes down, then the investors come in and the cycle kicks on. So you can track this from budgets because it tells you the future. Budget, that's what a budget is. It is the future of where the government's going.
Yeah, I think the point I would maybe make on state budgets that is a little bit unique or a different way when I'm thinking about it is when you're looking, or when I'm at least looking at state budgets, you're moving more from an absolute assessment of it, which is maybe what I would say is like Australia-wide, to a little bit more of a relative assessment. So like comparing states basically. So that's where you can start to go, okay, how it's less about in isolation how's Melbourne performing or how Victoria is performing, but it does then become a bit more how is the Melbourne situation or the Victorian state budget looking relative to Sydney, relative to Queensland, well, relative to WA.
Bad.
Yeah, a little bit, but that's where you can it's not just an absolute measure because the flow of economic performance, people, jobs, income growth, that types of things. It's not just in isolation. Victoria is not a closed country by itself. It's how it sits relative to how everyone else
Let me
is
help
doing.
everyone. You do not need to be Curtis Stewart, economics whiz, smartest guy I know to do this. Sorry, Curtis. You used to be super smart, but now that little computer of yours can do a lot of this quicker than you. Like, it can. What you can do is you can go on each website. ChatGPT can do this bit for you if you really want to shorten it. I don't like doing this because I find its data sources can give me the wrong answers. Sometimes ChatGPT get better. But what you can do is you can go on the websites, download the reports, stick each report straight into ChatGPT, put them all in there and be like, analyze each of these budgets on these single metrics, analyze differences, give me a report on 6 different questions that you come up with to get a good understanding of the economy. You can even ask ChatGPT, help me understand the state budget with relation to housing. What questions should I be asking it? and then put those questions into the reports and it'll give you table metrics across the board. And this is the thing, don't look at it in isolation. Trend is everything. Look at the change and look at the change in what's going on there. You need to know what to ask as a property investor, though. Looking at net debt isn't particularly useful because the change there is actually going to be positive for Victoria. It's just like interest rates coming down. The interest expense going out, the deficit associated with it is going to come down because interest rates are coming down. So you want to look at change, not the net amounts and the stock of things, because that's what you're looking for when it comes to housing. The state itself, they obviously care. They've got a lot of debt.
Yeah,
they obviously care about all of this sort of stuff. But that's kind of some of the things that you want to look for. And the important part is to look at change and what they're doing with it. If you look at individual budgets, you'll see WA's like rolling in it. They just got money pouring out of their ears. They got like a little bathtub of money being like, money, money, money. While the rest of they're basically just collecting revenue from everyone. They're absolutely on fire. They're always going to be richer than everyone else on a state by state level. But that doesn't matter because a lot of the time they're richer than everyone else and the property market doesn't do well. So you want to be looking at how it's being applied and the change from year on year as to what's happening.
Yeah, I would say, it's a relative assessment, relative to itself previously and then relative to other states.
Yes. You can use the state of state reports from CommBank as well for your quarterly breakdown.
Yeah, that's a good shortcut.
Yep. Yeah, you got to use shortcuts. Like no one's actually going through any of these data metrics. Even the very, 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 very best with big research houses and research teams, that's what economists do. They get the answer wrong all the time. More information actually gets you to the wrong answer. So you can synthesize and get the little bit of information that you want to get what you need out of this. And this is just tracking it over time to reinforce the messages that you get from the other 3 that we talked about. Let's go on the last point here, employment data. This is the last point that we look at, the main framework. Every month, the ABS jobs report comes out and there's a BI scorecard that comes out from the Labor Department, Australian Labor Data Department. employment, workforce, whatever it is. They come up with this awesome metric and you can toggle through these. The data metric's so good by the government nowadays. It was never this good when we were there. You can toggle through, it goes through a breakdown, gives you the change every month, where the jobs are going, employment growth, employment participation, youth unemployment. You track it, you track by industry, gives you such a beautiful picture of what the change is all the time. And you can see it month on month. And this is so, so crucial to housing demand because a job is the starting point to anyone purchasing a house.
Yeah, and the breakdown of this data, I think, is the real gold mine. So like if you're just looking at like headline unemployment rate, like that is not a rich enough data source. Like there's too many variables, participation rate moves and impacts that. Like you're not looking at a headline rate. When you're thinking about this data, you're trying to get an understanding of, are jobs being created? Yes. What types of jobs are they? Like a bunch of new high-paying full-time jobs is very different it sends a very different signal to a property investor than a bunch of people taking up part-time work or a second job on top of their existing work. Like those two very, very different data metrics. They might both hit the headline rate similarly, but very, very different when you break them down. So you're trying to work out, are jobs being created? Are they high-paying jobs? Are they full-time jobs?
Yes.
Like how is that looking? And if you're trying to get a sense of, is the population in this area becoming higher paid, basically? And is it a growing population that is becoming higher paid? If it is, then like massive green light, that's a tick. If it is people moving around jobs, if it's people changing between full-time and part-time employment, if it's movement in the workforce, that's interesting, but it's not the same, which is where being able to drill down into this data is actually really, really useful compared to just having a very, very quick glance at a headline rate.
Exactly. He's summed it up pretty perfectly there. It's not about the headline rate. It's not about the headline unemployment rate. You can get that anywhere. The media will give that to you every month. There'll be a news article. Turn on the ABC, you'll see it. But in this, you can see who's getting the jobs and how much job creation is actually happening and where. That's particularly important to housing demand. I think that's a wrap, Kurt. We've gone through our 5 economic metrics that drive all the data metrics and how to stay ahead of the curve, and ran through some very, very granular, specific information. A bit of a technical episode here where we're running through some details and reports and things like that you should look at. But
I don't think so. You just told people to go on ChatGPT and ask it what to do.
Yeah, but I told them.
That was your answer.
Yeah, of course. You got to find ways to simplify things.
Could be really technical.
Nowadays. Yes, of course.
Or just ask the AI for the answer.
Yes. We are live here, by the way. People have asked nowadays because podcasts can be produced differently. I saw a mortgage broker produce AI content. Absolutely amazing because the content was pretty cool, but his face wasn't moving at the same time. So, but that will change pretty soon. So, whole new world we live in. We are here. We are talking to you, not live, but we are talking about the awesome economic movements that will drive data changes and how to stay one step ahead of everyone else.